Alright, what's up guys? Gatie, part 3 of my GEMS Po3 Mastery. Let's not waste any time. Gonna put myself in the corner here. Today, we're gonna be talking about advanced concepts in Power of 3 and my Gatie's execution morning strategy. This is my work discovered from ICT. All of this information was from ICT and hours and thousands of backtests that I put into my model, okay? You won't find information like this put together in this way probably anywhere on the internet from where I know. Everything you're about to learn is from the knowledge of ICT that he's put out in various tape reading lectures throughout the years, as well as thousands of backtested trades from myself, as well as experience in Power of 3 from myself, okay? The four main concepts we are covering today over here: standard deviation projections and Power of 3, protected highs and lows, opening prices, and also Po3 invalidation / trade invalidation. So, okay, this is going to be pretty advanced concepts. I will quickly cover what these four are, and then we'll get into some examples and some lessons and notes for you guys to take over and backtest or do what you got to do. You don't need this in your trading whatsoever. It's just something I happen to see, and I use it when I can, when it's used as a confluence. Some of these I use every single time. Some of these are more of a confluence. So let's get started. Standard deviation projections. If you don't know what that is at all, I recommend you go to my YouTube channel and watch the video on standard deviation projections and measured moves, okay? I'm not going to waste time explaining what's a standard deviation projection and go into depth in that. I'm going to explain the specific ones that I use in my Power of 3, okay? Protected highs and lows are lows and highs that you can expect to be held within the market. So you would expect price to not come back and take this low, okay? Now, I don't necessarily put my stop loss at this low because usually the risk to reward is not good, but I'll usually put it at a PD array that's framed after this low and trying to multiply my trade's risk to reward in that sense. Opening prices, very, very, very important. Every single Power 3 I look for is an opening price. I'm going to teach you guys how I use that and when I use each specific opening price. And then just some as well as some invalidations for the Po3 when you can realize you're maybe wrong or right. All right, let's get to it. So first things first, standard deviation projections and Power of 3. There are 3 projections that I use, okay? There's 2 types. The first type is AMP. It stands for accumulation manipulation projection. This is when price is accumulated and we get a manipulation leg. So I want to project where price is going to reverse from. Okay, put that in your notes. You're projecting, I'll write it here, projecting where price is going to reverse from. That is the key of this one right here. Okay, so I'm going to put that in red. How can I do it? There's 2 ways. There's 2 ways you get a manipulation leg. Sometimes you have accumulation like this. So you guys can see this accumulation. And we will simply deviate from the range just slightly and then expand. So see how we just slightly leave this accumulation, just come down slightly and then go. That's what we call range deviation. That's what I call a range deviation, where we just ever so slightly leave the range, come back into the range. Some people call this a box setup. In and out of the range, spike, breakout, whatever you want to call it. To me, this is a range deviation, okay? Then you have reversal deviation, where sometimes you actually get some form of expansion. Now, this low doesn't have to be taken, but it can be. You get some sort of expansion from the original consolidation or accumulation, and usually that expansion, you can predict where it's going to expand to and then reverse from. Most of the time, you will see this one with your double purge. So if you see something like this, it'll usually look like this, where we take sell side, buy side, this is a fake long, and then we reverse one more time. Usually that's when you'll see this, okay? So this is, again, predicting where price is going to reverse from. The second type of projection that I use is distribution projection. This is when I'm in a position, I want to see how far can this potentially go, which level makes sense, where do I think it's coded to go by the algorithm, where do I think price is going to deliver before it reverses or retraces. This is where I use manipulation distribution projection. So once you have your manipulation leg, you can project it and you can expect for where price to go. All right, and that includes the retracement leg. You can use that as well. So I'm going to quickly go over my settings for each one. So range deviation, this is my fib. I'm looking at these 4 price levels, 0, 1, and then 0.25, 0.5, 0.75, negative 1. All right, that's the fib setting. And then you have reversal deviation. This is where I'm looking at these specific levels right here. And then the last one is distribution projections. This is where it's very similar to the reversal deviation. I added that -5 in as a red flag, where if we start going past -5, I know this distribution is probably somewhat intervened manually, not every time, but it's kind of like a red flag for me that, you know, order flow is very, very one-sided. It happens all the time, by the way. And obviously depends which time frame you look on, but it's just a sort of red flag for me, or something for me to keep an eye out. Let's go into some examples. So this is what a range deviation looks like. You can see in this example, we have a range, and then we deviate from the range, and then go the opposite direction. When this happens, I am looking for a deviation below -1. I don't want to see bullish order flow above -1. I don't want to see this, especially not with the fair value gap or anything. Sometimes it's not that clean. Sometimes it'll go 0.125. That's okay. But for the most part, we should be rejecting off of anywhere from these 4 standard deviation levels. That's how I know we're deviating from the range, right? If the range is 100 points, or let's say if the range is 10 points, right? I don't want to see a deviation more than 10 points, right? It shouldn't be that. At that point, I'm starting to tell myself this may not be a deviation from the range. It may not be a quick in and back out into the range. It might be something else. So I'm looking at these specific levels saying that, okay, I want to see a potential rejection from here. How can I trust it? We'll get into that later, okay? We'll get into that later. Now, something I want to cover. When do I look for range deviations? Very simple, okay? Asia session, looking at London high of day / low of day, or 9:30 Po3. So pre-market, I'll say pre-market when you have accumulation in Asia, you will see this. I use this. That's when I use it the most. You'll see a manipulation from midnight opening price in London, slightly deviating from Asian's range, and then a distribution towards other day. That's where you get your daily power of 3. We'll cover those models later. So the episode after this, that's where I'm covering all of my A+ models. Next one is the pre-market accumulation. When I say pre-market, I'm referring to like 9 a.m., 7 a.m., before 9:30. So if I see an accumulation pre-market, I can look for a deviation from that range in New York, and you can project the London high day or low of day, or the New York high / low. So that's your range deviation. Now, sometimes you get a New York reversal or a London reversal. This is where you get an impulse leg in London, and then we reverse later on in the day or in the session. So if you have, let's say, Asia accumulation, London manipulation in the form of an expansion leg, usually that expansion leg, not always, usually if it's going to expand, right, not deviate from the range, reversal deviation. So expand towards -2, -2.5. It can reach 4. If it's 4, then I'm a little bit more skeptical that this might just be a continuation profile. Ideally, I'm looking for -2, -2.5. But again, 4 is like your final target. That's 4 times of the impulse leg that we went lower. We should reverse now, you know? That's where I have that -5, and I'm saying, okay, if we're still going here, right, this is maybe I'm reading this wrong or something else is going on, right? So ideally, you get your -2, -2.5. Now, whenever you see these deviations, notice I'm putting this marker, this circle. That's because we're going to discuss later what a protected high or low is, okay? So usually Asia accumulation, London manipulates 2.5, higher time frame PD ray, you get your reversal in London session, and then you continue in New York. Or vice versa, you see a 10 a.m. reversal with power of 3 in New York session where pre-market accumulates, 9:30 manipulates, you guys know the Judas swing, and then 10 a.m. reversal in the macro or silver bullet. So typical deviation stuff there. Your last one Where's the wording? There's no wording. Your last one is your distribution projection. So we're talking about this one right here, the most classic, simple one you guys know. You have a manipulation leg. Your last manipulation leg, high to low, you project it. You're looking for -4, -5 if you're expecting a full candle PO3. And then if we get a retracement leg, for me, on every retracement leg, I'm expecting at least -1. Okay, sometimes -1.5 to -2, like in this area right here. But at least -1 is what I'm expecting, because if this is going to be retracement of, let's say, 100-point retracement, I'm expecting at least 100 points back to the upside. It should be at least equal. This is a measured move, okay? So it should at least come to -1. Sometimes you'll see that 1.5, and then, like I said, 2 to 2.5. So that's how it's usually done. That's how I use it. These are your textbook setups. Let's move on forward. Here is an example of range deviation. Part 1, we have a range. Part 2, we deviate the range. Notice I'm not looking at this. I'm looking at Asia and London. If you're confused about what I'm talking about, it's these times right here. Asia, London. We accumulated in Asia. Mark the Asia high to low. Deviation. Where did we stop? 0.025. Did we hit a key level? Yes, we did. We took out sell side and we touched the 15-minute fair value gap. So how can you trust this low? Well, we took out sell side, right? We touched the 15-minute fair value gap. That's step 1. Step 2. Step 3, we have a deviation from the range. Step 4 is you'd have to be bullish, right? Because if you weren't bullish, then you'd start looking at the opposite, right? Obviously, we have the power of hindsight here. What is wrong with this thing, man? So this is your protected high or low, whatever. We'll just leave it that big. And that's your deviation. So if we're going to expand, where would I look to project my leg? I would project it like this. You can see we went all the way past -4. I would have targeted right here though, right? We just kept going and going. So very, very bullish order flow. It's typical, all-time highs. You guys already know the drill. Your buy side liquidity pool here rests right between -4. And then you have this buy side that's between -4 and -5. So you can project your targets that way in terms of intraday daily power of 3. But what I want you to focus on here is the manipulation from midnight opening price. So I'm going to start talking about opening prices here. Where do I look for manipulation from? It has to be from the opening price, okay? It can't just be a fall short here. Like, this is not a manipulation. It needs to be from the price level at this specific time. The algorithm is time-based. I want to see manipulation from midnight opening, a deviation below midnight opening, from midnight opening, and then a move back up, right? This is your 15-minute breaker. You see we tapped in, and then we get that expansion. I think this is a news day or something. Doesn't really matter. Hopefully that makes sense in terms of the deviation right there. All right, what do we have here? Here is another example on the bearish side. We have, surprise, surprise, accumulation in Asian session. Take your high to low. Look at your deviation. This is -1. But Gatie, we traded above -1. That's okay. Look at your higher time frame key levels, right? You have relative equal highs right here. Do you think the algorithm is going to follow these relative equal highs, or is it going to follow your -1 standard deviation? It's going to go for the relative equal highs. Notice we didn't even close above -1. We just took those highs, traded a little bit into this wick, traded a little bit into the order block, and we went lower. How can I trust this as a protected high or low? Very simple. Your range deviations, -1, respected. Took out the liquidity. That's 2. 3, we have to be bearish. Bias comes first, so we have to be bearish. That's 4. How else can you trust it? Well, the breaker block that formed afterwards. Look at the bodies, right? The order block that formed afterwards. Look at the bodies, okay? Look at the 50% level. Bearish order flow comes in after this protected high is placed, okay? So that's what you're looking for. Another way you can expect this is, notice the price action right here. Midnight opening price. Let's fast forward a bit here. Look at midnight opening price. Did we go below it even a little bit? Barely. 1 or 2 ticks. So if this is a manipulation, it checks off the criteria of manipulating from midnight opening price, including the deviation, including the buy side liquidity, including the higher time frame PD array, right? There's probably a fair value gap there on another time frame, and then we go down. So we're bearish going into New York session. Where can we expect price to go? Very, very good question. First, drawn liquidity. Second, standard deviations. This red line is your daily volume imbalance. And then you have this data low. I think this is NFP low. And then you have some more equal lows over there. What aligns with the standard deviations? Remember, if this is your reversal, we're expecting not for it to reject that -1. It should go to at least -2 to -2.5. Have some courage and trust in your data and system, right? Now, this is fine to take profits here. I'm not saying you don't take profits here. What I'm saying is trust your distribution, trust your bias. You take your profits where you need to take profits, but it's always good to keep this in the back of your mind that if this is a true manipulation and today is a true expansion day, right? Because if today was a range day, then you're not expecting -2, -2.5. You're only expecting -1. We'll get into that later. But if today is going to be a classic PO3 day, you're expecting that -2, -2.5. In fact, you can even expect lower. But again, you have to look at your higher time frame and see what you're working with, right? -2, -2.5 is the minimum objective for any distribution projection. For me. You can see what happens later. We come a little bit lower, -3, and then the session's over. So you can see your classic PO3 there. Accumulation, manipulation, distribution, retracement, distribution, PM continuation. Right? Very simple stuff right there. All right, next. Here we are talking about trade invalidations. I think this is from today. So distribution legs after PO3 manipulation should reach -1 with ease and continue. So what was I talking about? Just like as I was saying right here. So if this London manipulation, why is this London manipulation, Gatie? Because it's from midnight opening price. Okay, it's from midnight opening price. Took a higher time frame PD array. Okay, if it's gonna distribute, it should distribute past -1 with ease. It should come to -2, -2.5. So notice this -1. What do we have here at -1? Some lows from London. Okay, not much, right? Our real objectives are in this gap right here, and it's -2, -2.5. Notice what happens. We accumulate. Some people view this not as accumulation, but we came down and we came back up. This is a range. We deviated from that range. How do I know this is manipulation? Opening price, 10 a.m. power of 3. We came above the 10 a.m. opening price, okay? And we get that breaker. So once we get that breaker, it's pretty much confirmed that the move lower is happening. You get the inversion. And this is the short I took today on stream. So you can see that AMD, it's hard to spot the accumulation, but you can definitely spot the manipulation from 10 a.m. opening price. That's why I mark my opening prices. So people always ask me, how do I use my opening prices? I'm looking for a fake move above or below the opening price, and I want to see that candle reverse. At this point right here, the 10 a.m. candle is bullish. As soon as it starts to go down and we get that breaker, what is this? This is a protected higher low. Why is this higher low protected? Because it deviated from the range. What's the range? Right here. Not even -2.5. We didn't even come and take out this buy side. We just came just enough, ever so slightly, took out the buy side here above 10 a.m. Right? That's 10 a.m. We took out the buy side and immediately with speed inverse this liquidity void, right? 2 fair value gaps. So one inversion there, probably a 2-minute inversion. Very clean. Immediately came up, tapped the rejection block, failed to take the high, took out the 1-minute short-term high. This is now an intermediate term high. Keep that in mind. And then we go lower and we continue lower. And again, you can distribute your projections here. So your last manipulation leg. Now, in this case, I will show you guys something very interesting. This is your last low to high, right? Your last low to high of the manipulation from 10 a.m., right? Let's see where this goes. -1 right there. How did we reach -1? With very bearish order flow, okay? We didn't wick, we came right through, we came with a solid bearish fair value gap. We even have 1030 power of 3 aligned with us right here. 1030, exact same thing. We deviated above 1030. Where did we deviate to? This is your range going into 1030, right? We deviated above. How do I know it's manipulation? Because it's above 1030 opening price. We came up, 1030 opened, we only came up. Where did we go up to? We went up and offered fair value into this bearish fair value gap. For those of you in my chat who watch ICT, see how we didn't touch the top of this fair value gap? Very bearish indication. You don't want to see it completely fill. We come up, we offer fair value, we dump down, we get the bearish order block, which is 1030 candle itself. Notice we put in another fair value gap. What is this again? The same signature and price where we don't completely rebalance the fair value gap. So we have another deviation here. Another deviation here. We got to -2.5 fair value gap. We went lower, right? You can again deviate this range. This is your manipulation leg. And you can see where it aligns really nicely, right? This is a small manipulation. So -4s can be a potential target. In this one, it's a larger manipulation leg. You're looking at -2, -2.5, right? Because this is not a range deviation. It is in this range, but we've already framed the reversal over here, right? So this is a large range. The last thing I want to say is, just remember what's on my checklist here. Oh yeah, so notice how we're getting to -1, right? Right here, we're getting to -1 within the same context with a huge bearish fair value gap. That's what you want to see. You don't want to see a wick. You don't want to see an SMT. You don't want to see your final sell side level at -1, right? You want to know where price is going right through that low. Huge bearish fair value gap. This is now a breaker block, right? This is exactly what you want to see, right? Look at that. We touched that breaker block ever so slightly, and we started to dump right after, forming another mitigation block, forming the order block, forming the propulsion block. That is exactly what you want to see at your -1 standard deviations. You don't want to see no wick. You don't want to see no inversion fair value gap. That's when you start saying, okay, you know what? Maybe I got something wrong in the power of 3. So next slide. Opening prices example. Not sure what I wanted to show here. Okay, so this is an example of how you can use opening prices. Today, we had 0 move below midnight opening price. I'm sure most of you can see that. We opened up at midnight and we only went up. This is from today's live stream as well. We called this all live, so don't call me Hindsight Harry. I was bearish the entire day, and this is exactly why. One of the main reasons was it's very rare to not see any move below midnight opening price. It can happen, but it's very rare. It's very rare, okay? So I'm looking for discount pricing, and it's typical for a Friday to trade back into the weekly range. So I'm viewing this as all manipulation. This is your last manipulation leg going higher. And you can see in this case, we're using midnight opening and then this huge gap right here as a drawn liquidity, right? You also have your sell side, you have London lows. But the key is here, the midnight opening has not been traded to, right? You want to see that manipulation into midnight opening. Now in this case, it's not a manipulation. This was the manipulation, and then you're distributing back. That's typical for a Friday. Again, price action is going to be always wonky going into December and trading near all-time highs. So just keep that in mind with everything that I'm teaching. Most of the data I got here was not from trading December or all-time highs, right? There's 12 months in a year. We're not always using all-time highs. So things are a little bit quite different right now. But hopefully you can see that's one way to use midnight opening price as a potential drawn liquidity. Usually price will trade on like below and above midnight opening price. And you can see as soon as we touched it, as soon as we got a closure above it, we used it as support and we ended up going back into the range. So very interesting price action there. And that works for all opening prices, right? So let's take a look here at the 1031, for example. So we already done this example, but in this context, we'll do it again. Opening prices, right? You want to see a move above and then a move below, usually forming a breaker block, right? I will most likely look for the breaker block in these instances. Again, a move above, a move below the breaker block, right? 930. Look very closely. All right, look very closely. This is 3 days. It all formed the same way. Look at this cursor. New York Open is right here. Did we go below it? Barely. We did not get manipulation. That means, what does that mean? It means whoever was long was able to stay profitable throughout this entire run. If they didn't take profits, their stop losses are most likely here. So if they didn't take any profits, right, primarily, and this for the entire day, because the same thing occurred with midnight opening. So you have to understand the narrative there. The algorithm is going to target those people who have been holding those positions with trailed stops here, with trailed stops here, with trailed stops here, with trailed stops below midnight opening for anyone holding positions overnight. Look at midnight opening. Look at that line. Okay? The breaker from the opening price. Okay? From the opening price. The breaker from the opening price. The breaker from the opening price. The breaker from the opening. 3 examples in just this session, this day today. Okay? Just this session, this day today. What is this? What is this? This is your last price leg before the move higher going into 930. Usually, you would want to see some move below 930. If it doesn't happen, that's when we use the reversal deviation, okay? The reversal deviation. We took sell side prior to 930, okay? Prior to 930, we took out sell side. We have accumulation, take out sell side. We go. Where do we go? All the way to -4, -4.5. This is all-time highs. It's difficult to see when we're going to potentially reverse from. We have some missing information here. So how do you trust this high, right? For starters, the distribution, right? Stopping between this range is where you'd want to see. The answer to your question is the S&P 500 reaching its key level, right? Its key level was the rejection block here. I use the 15-minute one, but you can see it right there. So that's your rejection block. There's also this volume imbalance that hasn't been traded to. Whatever you want to use, it's all it's there. So this premium pricing, these premium arrays, when we got there, the same time we got there, we got into you can see the -4, and we got there into the same time when NQ reached that -4 standard deviations. So ES was framing the shorts here. Again, you're looking for that move below the opening price, okay? New York open, we go up. You're looking for that breaker on the move down. Okay, last concept we're going to cover. So we talked about the projections and how I use them. We talked about the opening prices. We talked about the invalidations and trade invalidations. I know that was very quick. I'm not going to do a 4-hour lecture on all this stuff. So this is what you get, you know. Protected highs and lows, okay? The last concept, we're going to do it live together. Okay, so like I said, the last concept to discuss is the protected high or low. These are 2 ways you can identify your protected highs or lows. So just know the most important part here is the high or low is, first of all, this is subjective. There's no certain way to determine whether or not it's protected or not. It's going to come down to probabilities. You need to understand that it's only protected until the algorithm plays out its code or narrative in price delivery. Once that is delivered, that high or low no longer serves its purpose and is now likely going to be targeted as a form of liquidity. So one way to identify a protected high or low is through power of 3 and standard deviation projections. This is where we use range deviation, reversal deviation. That was prior discussed in this lecture, so you should go back and view that if you need to. But once we come above this opening price and then leave, we have the standard deviation projections as a confluence. You can expect this high to be protected now because it's done its service, right? It's going to now be used to send price lower. Lower prices were accumulated here by smart money to send price lower. So it's going to serve as a protected high until those positions are distributed to whatever form of liquidity that's resting below. And then it's no longer in that narrative, right? So we put in the high, let's say that was coded, we distribute lower to where it was coded to go. It no longer has that purpose as the price level, and now in fact can be targeted later on. So just know that it's not always a protected high. The idea is we came above the opening price, we got the confirmation of lower pricing, and we are bearish already towards an objective. We can expect this high to be safe because price is going to move lower towards that objective, right? It doesn't want to come make higher highs. Price is ready to go. The second way is market structure. Intermediate term highs, intermediate term lows. If you don't know what this is, I'm not going to teach advanced market structure in this video. ICT 2022 Mentorship Episode 12 will teach you what you need to know about intermediate term highs and intermediate term lows. But when you see this and this, that is your intermediate term high, intermediate term low. In the sense of Po3, it'll most of the time form like this, where we have a soup and then break lower and put in short-term highs lower. Usually this is a fair value gap. Usually this is a fair value gap right here, okay? Let's give another example of advanced market structure in Po3. Your other example in advanced market structure or protected highs or lows is when price enters a fair value gap. So another form of an intermediate term high is like this. So let's say, right, you got the breaker. So you got the breaker block right there. This is whatever, right? So you get a breaker block. The idea is, right, when price comes back into this fair value gap and we're still distributing, you can trust this high as a protected high or low because it's trading into a fair value gap. The only purpose of price coming up here is to retrace into fair value, into premium, accumulate more orders, redistribute price towards that objective, which we were targeting prior, right? Making this a protected high or low. So in my models, which we're going to be covering in the next episode, some of the A+ models, you'll see that in this retracement leg right here, I don't trade the fair value gap. I always wait for the inversion. So for me, that's what confirms the protected high or low, right? That's the trade that I took today. If you were in the live stream, I'm always looking for that retracement and then the inversion when I'm trading the inversion, right? So that's how I identify my protected highs or lows in that sense as well. The other way to identify protected highs or lows, so let's clear this up, is time and price theory. So what I mean by that is time, time of day, and then your premium arrays, right? So if you have accumulation in Asia and you have manipulation in London, you can, and you're bearish, right? Obviously you can identify this as a protected London high of day, being that the narrative is a London reversal where New York is going to continue, and we can talk about that in that sort of context, right? Protected by the time of London because you know probabilities speak, and the probability of London high on a classic expansion day where we're bearish, if it manipulated properly and where you expected it to reverse from, you can trust this time of day, right, to not get traded back into. Right? The second way is through distribution. So let's say we have something like this, right? And as we retrace right here, we have our 950 macro, right? You can trust this low for other reasons, as we discussed from the Po3 and the standard deviations and the higher time frame PD arrays that we traded into. But also you can trust it because we are inside of a macro. And inside of the macro, you're expecting a price run towards liquidity or inefficiency. If you don't know what I'm talking about, view my most recent video. So being the fact that we're in that macro, right, we're probably not going to take out this low, accumulate more lows to go higher, right? We're going to use this time to distribute, to expand our position, smart money's position that was accumulated at these lows. And you can trust that this low will form, and you can trust that this low will form as well and hold. Right? That's the idea of time and price. And then the final one is obviously higher time frame PD arrays. So let's say you're bearish, we trade up into a higher time frame PD array and we break lower. You can trust this high as well, especially if it aligns with power of 3, especially if it aligns with a distribution level, let's say -2, and you can definitely trust that and use that as a confluence for other ideas. So those are the kind of ways you identify your protected highs and lows. For me to give you one quick example, we can go right here and we can see, right, 10 a.m. we come up, we take the buy side. That's a liquidity sweep. So that's your PD array. And we break lower, 10 a.m. power of 3. We already talked about the deviation. We got the breaker block. You can now officially trust this high. Now, if we're going to come back up, listen closely, if we're going to come back up and look for fair value, right, you can now trust this high as well, because we only came up to offer fair value. The goal is still to go lower. 10:30 opening price, we come up, same exact thing. We just come up to offer fair value. Sometimes we will come up and take out this high. Sometimes. Not all the time, sometimes. You need to understand the timing and the narrative of the market and its condition, right? It's condition. In this condition, we were very expansive. Order flow was very one-sided. We were obviously in a hurry to get to that price level, which was that new day opening gap. So you need to understand the condition. In other conditions, for example, seek and destroy, you might see this high get taken, and then you get something like this. That's okay. You need to identify the condition you're in. You need to look at the PD raise, look at the time, 10:30. We came up, broke down. The order block is confirmation, right? The fair value gap formed here. No one's saying you have to enter here. I don't enter here. I always wait for the inversion, like I said. Off any retracement, I personally wait for an inversion. There's a 15-second inversion right here. So that's the kind of idea. So time, power of 3, higher time frame PD raise, stuff like that. All discussed on that last slide. That was just a quick example I gave you. For example, midnight opening, range deviation, right? Examples we've been talking about through the entire lecture. Here's your protected high because it has a higher time frame PD ray, which is this buy side, and you get the breaker from midnight opening. All that stuff aligns for your protected highs and lows. So with that being said, we have now discussed standard deviation projections and power of 3 in an advanced terminology and an advanced lens through these deviations. We've discussed protected highs and lows and how I identify them. This is me. I'm not saying you need to use everything I taught in this video. If this doesn't interest you, that's fine. You know, this is for me. People asked me to make this video, so I made it, right? I talked about opening prices and how I use them. In my opinion, everyone should use opening prices. You need to understand where the higher time frame candle is going. To do that, you need to see where the opening price is, right? And then we talked a little bit about invalidations in Po3 and trade invalidations. There are many ways to know if your trade is invalidated. You don't need to do it the same way I do it. Obviously, I have multiple ways to know. Sometimes you can just read price, read the candles, see what they're telling you, look at the speed, look at the price action, look at the time of day, what's exactly happening, look at the intermarket analysis between two correlated assets, see what's happening like that, the market condition. All of those things can invalidate your trade idea. So you can use those, but you can see I covered these 4 concepts. Next video, I will discuss my A+ models for 930 power of 3. I'll be giving out my entire playbook. I will discuss my models for daily power of 3. I will also give out my playbook and my seek and destroy power of 3, which is applicable to both the daily and the intraday session. So with that being said, I will see you guys next time for those videos. I hope you guys learned something today. I know this was kind of quick, kind of advanced. We kind of got through everything very quickly, but this is what it is. You know, I don't have time to do a 5-hour lecture. If you have any questions, you can join my Discord and ask me. And with that being said, I'm signing out. Peace.